Hello, everybody. It's Tom Sheridan and Chris Darbyshire from 7am. Welcome to the Q2 2014 results from the Asset Allocation Committee discussion. Chris, wobbles. We're on about wobbles today, I gather.
That's right. We've had a few wobbles in markets in the first quarter. Initially, we had an emerging market wobble, started by concerns about the Argentinian peso, which seemed to have a snowballing effect into other emerging market currencies. We have fears of a China slowdown, and we hear stories of defaults and so on in China, which we haven't heard before. And then we had the Ukraine.
Right, lots of fun. A lot of it politically oriented, not necessarily economically oriented, and dividing the two has become one of the art forms which is necessary to run the multi-asset portfolios that we run.
That's right. I think the economic story has been mainly about emerging markets and will they slow, how much will they slow. But actually, the economic story has really not been about developed markets. The US economy continues on track towards a normal year. The UK is going great guns at the moment. And then we have Japan, third largest economy in the world. Is it rebounding? Will it get over the VAT hike in April and so on?
All right, well, why don't we take them one by one systematically? Because if you were to read the press, again, our good friends with the headlines, you could make either case for the US, you could make either case for Europe, you could make either case for China, you could make either case for Japan, you could make either case for emerging markets. And really what we need to do is to distill the noise and figure out what is it that we really think, why do we think it, and what are we doing about it. Let's start with the US.
So the US, I think, is the easiest and the clearest story. And there we see not only is GDP growth on a reasonably good trajectory, but actually the stock market as well is pretty much within spitting distance of its all-time high.
So the recovery has not run out of gas yet?
Not at all. In fact, you really can't even say there's been much of a wobble in the US in the first quarter.
Right, so cross off one wobble from the list. Shall we take Europe next? Because Europe structurally probably has more questions than the rest of the world.
Yes, it does. And European stock market performance has been pretty good. It's about 3% off its recent high, which isn't bad given the Ukraine is on Europe's doorstep. But the economic story in Europe is slowly coming through. Earnings aren't really recovering as fast as analysts had expected, but it's not really putting people off yet. I'd say given the Ukraine, given the nervousness of markets in Q1 and the slow rate of GDP recovery, Europe's doing okay.
Politically in Europe becomes a very big question. Stability, non-stability, are the banks going to be centrally managed in Europe? What's the structural political side of the question in Europe?
I think it continues to be a case of Europe is making the right moves towards a more federalized society, and we saw good progress with bank deposit insurance in Q1. Probably faster than we expected. So I think the story with Europe is always it's slow, but it's moving in the right direction.
Right. And we're probably looking at a generational event. This is not going to happen overnight.
Very true. The generation being born today will grow up in a Europe which is much more united than it is today.
Shall we move on to Japan? Japan, as you already mentioned, they had the VAT worry, scare, wobble. But the real question, I guess, is Abenomics. Is it working? Is it not working? What's the evidence?
So we had a good run with Japan up until the end of last year, and I think people were prepared to give Abenomics the benefit of the doubt. In Q4, then the GDP numbers that were announced were pretty disappointing, and they were at a materially lower rate than people had been expecting. And I think that began to make people think, is this really going to happen? And then we've got the VAT, which in Japan is called the consumption tax increase, which is coming through in April. So I think those two things together have been enough to put a dampener on Japan, which actually is down 10% year to date.
The stock market's down 10% year to date, but the economically, what are we looking at in terms of inflation, growth, the kind of numbers that you want to keep your eye on?
All still pretty good, actually, and industrial production very, very strong in Japan in January. We've got, yes, there are concerns about consumer spending, but actually spending by businesses is very much on track, and inflation, which is the big battle in Japan, can we get inflation back to a normal level, that is coming through as well. So I think it's too soon to say that Abenomics has failed. I think we've got the consumption tax hike coming in very, very shortly. Let's hold our position there. And once that bad news is out of the way, maybe I think people will start to give Japan the benefit of the doubt again.
And what's happening to the currency, to the yen?
Yen has strengthened quite a bit in the first quarter. And over the past 18 months, strengthening of the yen has been associated with falling in the stock market and vice versa as well. So the two do appear to be correlated. And we're looking for that correlation to break down as one of the sort of buy signals, if you like, for Japan.
All this, of course, in the context of, a 47% rise last year in the Japanese equities? Absolutely
amazing rise, and high 40s last year. And let's not forget Q4 2012, when Japan was up 20+% just in that quarter.
Yeah, okay, so a bit of a wobble in Japan, probably not unexpected. China, becoming more and more of a dominant force in the world in so many different ways. What we're seeing right now is the new regime is well and truly in place right now, and the policies of the new regime we're beginning to see, and it looks like a little slower. Is that on purpose?
I think it probably is on purpose, but I would also say that, a country as big as China, second biggest economy in the world, it can't grow at 7, 8, 9, 10% forever. And, there are risks to having that kind of level of growth. So for me, slowing the growth is part of China moving towards being a developed country.
And so how is it that they are slowing the growth? There's been a lot of talk about credit. There's been a lot of talk about corruption in China. Is this the early part of what will be a 10-year regime, taking the bad news up front, trying to avoid a real big mess later, and allowing some people to default now to send a message to the market that it's not all a one-way bet?
I think that's exactly what it is, and I think the message is we are moving towards a purer form of capitalism than we have at the moment. At the moment, companies in China don't really default. Investments that private investors have made in what are called trusts are perceived not to default. And these investments are quite often very, very risky, and you and I would think very hard before we make those investments. But in China, it's considered abnormal for things to default. So I think point one, you've got to get the Chinese citizen aware that in a capitalist society, not every investment you make is guaranteed by the government.
Right. And to me, that sounds fair enough. As a matter of fact, I think over the medium to longer term, I'm actually a little happier to see a bit of calm, a bit of reason, a bit of capitalist logic, if I could put it that way, injected into the Chinese economy.
I think it's good. I think the worry for me is more about, will there be social unrest? Does this somehow appear to Chinese people as a change in the rules of the game that they weren't ready for, they weren't told about? I think that's highly unlikely. I think Chinese people are, like everybody else in the world, quite aware that investments can sometimes not return the money invested in them.
Fair enough. Emerging markets has been pretty much the story of the beginning of the year. We did a special piece on it a couple of months ago. We've already highlighted to people that emerging markets is actually not one big amorphous mass, but actually it's a series of different countries with different circumstances, both in terms of growth, in terms of inflation, in terms of trade balances. Where are we in the emerging market ex-China world at the moment?
So I think we've got a bit of a slowdown, but not a particularly serious slowdown. And I think then we've got certain markets, Turkey, South Africa, where stresses are somewhat higher than normal.
Yep.
And the amazing thing is that in the world of emerging markets, even a slowdown is, barely a pinprick compared to the world of developed markets. A slowdown means that Turkey grows at 2.5% rather than 3.5%. They're pretty decent growth rates.
Right. So global growth, what are we looking at for global growth this year?
So we're looking at global growth of around about 3.5% for the year, and it was roughly 2.5% last year.
And 3% and a bit growth with none of the major components in recession.
Correct. That's absolutely right. The only sort of negative we see is China at the moment, which is still growing at quite a rapid clip, just not as rapid as last year.
Right. So is this the world gradually trying to right itself after the tremendous shock that it took 5 or 6 years ago when we had the Lehman incident and the Great Recession, if we can call it that?
Yeah, I think that's exactly right. I think you've got the world for the first year since then, all economies pointing in the right direction and all pointing in the right direction at the same time.
So we turn our focus in that kind of environment to the central banks. And how are the central banks reacting? And are they going to pull the plug too soon? Are they going to throw us back into recession? Are they going to leave it easy policy for too long and we wind up with wild inflation? And indeed, in some of our competitor portfolios, we see both views plain to see in the way they position themselves. 7IM view.
So I think people are massively exaggerating the impact of central bank policy. I think there is a bit of an obsession with tapering at the moment. In 6 months' time, tapering will be over as a concept. And we'll be back to how strong is the economy and where will interest rates go. And that's a totally normal paradigm. You expect interest rates to tick up when the economy is growing. And so I think we're into, I think investors are really concerned about the relative change of pace in monetary policy, not the fact that in absolute terms it's very, very positive at the moment and will be for years to come.
And what I'm hearing from central banks is even though the next moves might indeed be up, we're talking at a duration, which is several years, and a pace, which is a couple of %. Doesn't sound like the end of the world to me in terms of central bank policy.
I quite agree. I think it will be a much more muted sort of increase in rates that we get.
So if we have this sluggish return to growth, more or less sort of coordinated, some people trying to reduce the errors of the past, central banks continuing to be fairly benign in this environment. So from an asset class perspective, where does that leave us and what do valuations, let's start with equities, what do valuations look like?
So valuations, we think, certainly higher than they were a year ago as the equity market rises outstrip the rise in earnings. But still we don't think they're at boiling point and they're certainly not a red flag to us.
So boiling point, I mean, that's almost an inflammatory phrase. Are they at long-term averages? Are they a little above them, below them? Is it different by region?
So I'd say the US is at or above its long-term average, whereas pretty much every other region in the world is below its long-term average.
Okay. And yields on equities, they still look fairly good versus the fixed income alternatives, don't
Well,
they?
this is it. Dividend yields are still very, very attractive. And so I think, I would argue that people who argue, for example, that the US equity market is overvalued should look at the dividend yield. It's not, those dividends are very sustainable and the dividend yield is very attractive.
And the larger companies pretty much cash rich.
Indeed, very safe balance sheets, lots of cash available. And the question there is, does the cash go back into the economy through investment or does it go back to shareholders through buybacks and dividends?
So the overweight equity position that 7IM has had now for, a couple of years?
Indeed.
We're staying with it?
Absolutely stay with it. We're at the beginning of several years of synchronized global growth, maybe not at a particularly rapid clip. We don't think that's a bad thing.
And geographically, are there any particular accents, or are we pretty much overweight around the board?
We like particularly Europe and European small cap, mid cap, so slightly smaller companies than the norm. We like Japan and we like emerging markets. And we like all of those on valuation grounds, that their valuations still have a lot of upside. And we think as global growth comes back online, those markets will benefit.
I can remember you saying to me 3 or 4 months ago when we stayed with our emerging markets position and, in fact, added a bit to it, and the same with Europe, that this is going to be the right call, but it may not be the right call very shortly. But we don't get to time it exactly, do we?
I think, the better the valuation opportunity, the more you have to be patient with your timing.
Fair enough. And does that have a different gradient according to risk profiles in 7IM?
Yes, I think it does. I think because of the way we manage money, more risky asset classes tend to start with a neutrally lower strategic long-run allocation.
Okay. Fixed income. As long as we've liked equities, we really haven't liked fixed income. We've made a couple of very strong moves in terms of shortening maturities, in terms of taking some credit and some currency exposure, some of which has been very successful. Tell us, quick recap what we did, but more importantly, what are we doing next?
So the big thing we did was, as you say, was cut the maturity of our gilts down, replace sort of the safer government bonds with Italian and Spanish government bonds, where we thought that the risk was coming down very fast and the yields were very high. So we made some good returns from that trade, which we will continue to do because we still think there's a dislocation there in Europe. More importantly, going forwards, we want to be in the slightly more riskier parts of fixed income, so high yield, where you're still getting, 5, 6, 7% returns, rather than developed world government bonds, such as UK and US, where the returns are really still 3%-ish. We think those bond markets where the central banks have been buying huge amounts of bonds over the last few years are still potentially going to have a rough ride.
Okay, so that's a pretty consistent message from 7IM really for the past year or so in terms of positioning on equities and on fixed, with a couple of nuances. The alternative space, we've toned down over the last year or so our exposure to alternatives with very, very clear ideas on what to do on equities and fixed. Commodities now, if you think emerging markets are okay, you think we get continued 3-odd% global growth, what's the view on commodities?
So we had a big discussion about commodities at the recent round of tactical asset allocation meetings. And I think what we decided to do was leave commodities at a zero allocation. What we chose to do instead was increase our Asia-Pacific allocation. And Asia-Pacific is a region which is mainly Australia. Mm-hmm. So about 60% of that equity market is Australia, which is actually mainly a commodity play. It's a commodity play through exports, partly to China.
So Asia ex-Japan is 60% Australia.
It is.
I wonder how many of our clients know that.
Yeah.
Okay, fair enough. Property.
Property, we had wanted to go overweight UK secondary property. So this is not your sort of prime London office space or retail parks. It's really sort of the high streets in secondary cities. But actually, we found the liquidity just wasn't quite good enough to get that trade implemented. So we spent a lot of time analysing how we could do it, and we think that we are going to pass on that opportunity purely to maintain a high level of liquidity in the funds.
Okay, so giving property a pass, giving commodities a miss, what are we doing in the alternative space?
So what we're doing is we're actually cutting back on our alternatives again. So we had bought dividend futures.
Yep.
And this gave us exposure to just the dividends paid by European companies over the last year or so and into the future. We've made good money on that. The dividend streams from European companies have been pretty stable, even though the stock prices go up and down a lot. Mm-hmm. And we're taking our profits on our remaining dividend positions.
Okay, so really from 7AM right now, the clear equity, fixed income, similar story to what we've had for the last couple of years. And as ever in these conversations, we usually wind up with one of the big hidden swing factors in the portfolios, which is currency. What's our current view on currency? And very importantly, what's our current positioning with regard to currency exposure?
So our big currency exposure, as you say, is actually the dollar. And just after the new year, the dollar peaked at about 165 and a bit. We took our hedges off, so we went to being exposed to the dollar in our portfolios. Yep. Since then, it's been up and down a bit. We're slightly in the money at the moment. But here's the principle here. While Scotland is on the horizon, there is a chance, albeit small, that fears around Scottish independence and what that means for the UK economy and some of the uncertainties around it and the fact that businesses might not be so happy to invest in the UK, we think that's a real risk. So we're going to stay pretty much unhedged on the dollar until the Scotland issue is resolved.
And the other currencies?
So we continue to maintain our hedges on the yen. Still think the yen could get a bit weaker in the short term. We continue to hedge our European fixed income exposure, which is mainly our Spanish and Italian bonds. And we continue to hedge the Aussie dollar.
Okay, so that's about 17% dollar exposure in a balanced portfolio, for example?
That's exactly right.
Okay. Nice, crisp, clear ideas, very clear implementation. Performance over the last couple of years been pretty much exactly what we thought it was going to be. Chris, well done. Keep going, and we'll see you soon. Thank you.